Well, you know it. If it's Friday morning, it's time for another episode of the About Mansfield Consumer Advice Series. I appreciate you being here today. As we do every Friday, right here on the podcast, we bring in our financial philosopher. That would be Phillip Washington Jr. Say hello to the audience.
How's it going, audience?
How's it going, audience? And Phillip is also the host of Wealth Building Made Simple. And he comes into the studio, the Podcast Mansfield recording studio, and records his podcast. If you actually want to listen to it live, it's usually every Friday morning around 9-ish on LinkedIn. And you can also catch that on your favorite podcast player. And then he comes over here, and we do this little bit, the 10 minutes of 10-minute nugget of golden information. And you can see the gold behind him and the gold in his shirt. And for those who are watching live on Facebook, of course, you get the director's cut where you get the green background. And so anyway, Phillip, welcome to Friday.
Thanks for having me. Thanks for the LinkedIn live plug, too.
Absolutely. The topic today, VCs are the new bankers. And so first of all, we're going to go really basic here because we have a lot of listeners, a lot of watchers out there, a lot of viewers who may not know what a VC is. So let's start with, what's a VC?
A VC is a venture capital firm, as opposed to, I'm giving it relative to a bank. So venture capital firms are the firms that finance startups at different stages, whether it's before they get started, after they get started, after they're mature, before they go public. But they're the finance stream that steps in before public markets and when bankers don't want to lend, because bankers don't want to lend something new. Bankers like to lend to established businesses with strong cash flow that's been providing that cash flow for a few years. And VCs are like, nah, we will bet on ideas.
So a VC is they're investing in new technology. They're investing in the future.
They're investing in the future.
Can you give me an example, then maybe a type of business that a venture capitalist would invest in?
So, Facebook, Amazon, Google, Spotify, Shopify, all Zoom, like all the new businesses that are bringing in the new age. Before they went to public markets, they all were funded by VC because they required a lot of capital.
Yeah,
and these were businesses that just banks were not comfortable giving billions of dollars or hundreds of millions of dollars to, and so that's where VC stepped in and filled in the gap.
I would assume through several transactions, they're acquiring their capital. Where are the VCs starting their capital from?
Yeah, so you can go all the way back to I'm gonna get the dates wrong, but like the early Texas Instrument chip making time period, and in the U.S. where Silicon Valley started in the 70s. And those early technology founders, eventually, they had seed capital from wealthy families, and they exited with a lot of money. Because whenever you invest in innovation, and there's not like the supply and demand of capital is off, meaning if you're investing in the future, you already have resistance coming from people that just don't like change. So you're not going to lead a lot of investors because you got to, and then the banks are not in. So the few investors that do invest in capital, combining that with opportunity that's growing at 30, 40, 50, 100% a year in these days, when you do end up get big enough to where you can go to the public market or bankers willing to lend you money, the exit is huge. Like the amount of cash that the stock owners and the investors make is massive. And so starting in the 70s, you had these buyouts that just built massive amounts of cash. Like the amount of cash was like, Middle East level of cash when in the 70s when we needed all that oil. And so they sat on a bunch of that cash, and then right, if you're an innovator and you made your money through innovation, you're not going to turn around and then invest your money in like old economy stuff. You're going to keep looking for innovators. And so the innovators invested in innovators, and they were the capital suppliers of innovators. But innovation happened so fast, the VCs still never, like, it's going to be hard to have enough capital to support the innovation of the world, right? So it organically snowballed and built from innovators who exited and invested new innovators and exited, and it became a compounding effect, right? Because like if you when you invest in innovation, you do it over and over again, like you just get so much money you don't know what to do with, especially if you're good at it.
Yeah. A question then about bankers versus venture capitalists. A banker will I've got a project, and a banker will fund a low risk, if you will, project. A venture capitalist may go into a high risk because they're seeing the return. Is there a difference in interest rates between a banker and a VC?
Yep. And the way they manage risk is differently, right? So a bank will say, all right, we're looking to make, I'm just making up a number, 6% a year on the money.
Yeah.
That's what we're looking to make, and the bank gets to make the money because they actually don't even put up any money, right? They use the deposits of their customers, and they make money on the spread. So, and so they want to be able to not lose the money because they're using their customers' money. So they go for a lower risk, kind of like a bond-like return. And so they're like, since it's 6% and we don't want to lose money, we're going to need like strong cash flow or collateral, because if you don't pay back the loan, we need to be able to get the money back. Versus, so their risk management is through like strong underwriting, collateral, strong cash flow. Of venture capital or venture capitalists, they may have $100 million, but they may invest, like $1 million into 100 deals, right? And they're comfortable in 100 deals that like have maybe no cash flow, right? No collateral. But what happens is they mathematically know they probably will lose money on. They're probably going to lose 30 million, and because those companies are going to go out of business, and then maybe 40 million will just break even or make a little bit of money. But then the 30 million that they invest in the superstars will make multiples, to where their 100 million could turn into maybe 200 or 300 million, just from the 30 million 10 times in their amount of money. So they diversify to spread it out.
And that helps, right? That helps offset the loss.
That helps offset the loss. It's correct. So they're looking for massive overall returns that are 10 times or more the money they put into it.
Can't we just buy a Powerball ticket?
Right. Yeah.
Although I was reading in Forbes the other day that the tax bill on a $1.5 billion payout is about $800 million.
Yeah, that sounds about right. Yeah. You'll have a more preferable tax bill if you do carried interest with a venture capital fund.
Right. But in all honesty, I wouldn't mind this Saturday, tomorrow, paying $800 million if that means winning $700 million.
Absolutely, yes.
But then, and my wife and I were talking about this. Number one, you have to play to win. So I'm not sure I'm going to win tomorrow. But it's always nice to. What are we going to do with $700-800 million?
I got some ideas.
And her first thing was, we're going to have to find a financial advisor. So
I'll be your full-time wealth manager. Yeah. I'll be like, all right, guys, I'm closed for business.
I do know a financial advisor who could probably handle $700 or $800 million.
Yeah, I got some ideas.
Okay. All right. In closing, we've got about a minute or so. You want to wrap up? VCs are the new bankers.
Yeah. So basically, think like a VC. Invest in the future, because the future is where there's a ton of money to be made, and there's a low supply of money funding future ideas, and you can be like this in the stock market if you're betting on things like Bitcoin, crypto, NFTs. Art Innovation Fund is a good one, a good way to buy like a liquid VC. We own it for ourselves and our clients. So, but the thing is like, bet on the future, right? Think with that mode, and it'll lead you to some of these investment ideas that I spit out, which are just ideas, not recommendations.
Yes, I love your recommendations. If someone wanted to reach out to you with an idea, and because you're kind of the conduit to several types of ideas, and so they've got an idea that may involve financing, and how can they reach out to Phillip Washington Jr. for more information?
Best way is stonehillwealthmanagement.com. That's stonehillwealthmanagement.com.
There you go. Phillip Washington Jr., we do this every Friday morning right here on live on Facebook. We also then transfer this over to YouTube for the finished product. We also then send that over to LinkedIn. And you can also listen to the podcast on your favorite podcast player. Phillip, let's do it again next week.
All right. Thanks for having me, Steve.